Hello and welcome to another Smaulgld live stream. It is Saturday, November 2nd, 2019, and that means it is Saturday night silver with Smaulgld. And tonight's topic, how timing your silver purchases can dramatically impact your return. I've got a series of new charts I want to show you on that particular topic. We're also going to take a look at the Dow silver ratio. We're going to look at how many ounces of silver it takes to build or to buy a house, a single-family home. We're also going to look at silver in the Indian rupee, how it might impact silver sales or imports there. And we're also going to take a look at the Comex open interest silver. We're going to look at the amount of increase in the silver ETFs and in the Comex warehouses. So let's get started. All right, so what I want to go through tonight, something we talk about all the time. A lot of people say, well, silver is a store of value, and they just kind of leave it at that. And I've been arguing it really isn't. It's a spike and dive metal. And gold, you'll see, will hold its value more consistently over time. That means that when silver rises, it rises a lot, and when it falls a lot further than gold. And it also seems to rise faster than gold, but it has long periods in between where it pretty much does nothing or underperforms a lot of the indexes. It underperforms gold. And you somewhat wait for that big spike to happen in silver, as had happened in 1979, 1980, and also happened in 2009, 10, and 11. And then immediately after both of those peaks in 1980 and 2011, the price fell back down to earth. Now, we're not going to get into the concept of manipulation, why it happens, and whether it'll happen again. But historically, since 1974, and the reason I use 1974 is when both silver and gold can be compared on an apples-to-apples basis, meaning that officially silver was taken out of the U.S. monetary system between 1965 and 1968, 1965 being the year they stopped making silver coins, so the coinage were no longer circulating as currency, silver coins. And 1968 is when they stopped redeeming silver certificates. Also, during that time period, from 1934 to 1974, the United States citizens were not allowed to own gold, and the price of gold was fixed by an act of Congress, the Gold Act of 1934, at $35 an ounce. So you really can't say what gold and silver did versus each other from 1934 to 1974. You couldn't own gold. The price was fixed at $35, and they were manipulating the price of silver for the purposes of coinage. But by 1974, at the end of December, they started to allow American citizens to buy gold again. And in 1971, in August, Nixon ripped up the Bretton Woods Agreements of 1944, which permitted central banks, not citizens, to convert their dollars. If they brought their U.S. dollars back to the U.S. Treasury, the United States would redeem them at the set price of $35 an ounce. Okay, so by 1974, the end of 74, people can then buy gold and silver equally in the United States, and presumably the price of gold and silver were now free floating. However, that was the same year, 1975, they introduced Comex gold and silver trading. So yes, gold and silver now trade on an apples-to-apples basis on the Comex, but there are significant differences between the Comex trading of silver and gold, primarily being that the gold trading is much larger, and therefore it's much easier to manipulate the price of silver up and down, and that also accounts for some of the spikes. Other things that account for the difference in the price is gold still retains a monetary element to it, in that the central banks do hold it. 20% of the world's gold is held by central banks. It is considered a reserve asset by central banks, and just recently Basel III allows any bank to hold gold just as it would hold cash. It's interesting, they had to elevate gold to the level of US dollars, but indeed gold is recognized in the financial system as money, as a financial asset, whereas silver is not. And silver's demand profile is much more towards a use as a commodity, and solar panels, yoga pants, electronics, and so on. And the bulk of gold demand, while it's jewelry, it's 50%. A lot of that silverware, a lot of that gold jewelry demand is investment demand, and the rest of gold demand is only a sliver of industrial demand by 8-9%, but gold has a 40-50% investment demand, then it has jewelry demand after that. So about 90% of gold demand is really investment demand, whereas silver's investment demand is only about 15%. There's about 15% jewelry, 15% silverware, and the rest goes to the industrial uses. All right, now let's look at what's happened as a result. Now that you kind of get the general picture since 1974, how they're trading, what they're trading like gold and silver, let's look at some charts, some very, very interesting charts. They go back since 2000, and the first chart you're going to look at and say, well, that's good. I like this chart. I'm pretty happy. If I bought in 2000 and I just held, just threw my money down and didn't think about it. Okay, let's take a look. On January 1st, 2000, the new millennial starts. Actually starts in 2001, but this is how they do it. January 1st, 2000, if you had bought gold at $287 an ounce, well, today or on Friday, it'd be $1,508, and you'd be the clear winner depending on which precious metal you bought, whether it was silver, palladium, platinum, or gold. Yes, indeed, gold since 2000 is the winner. Now we're going to see how recently platinum has been a big winner. Palladium's been a big winner. We can see spikes on this chart in silver, spikes in platinum, and more recently spikes in palladium. But if you take into account the overall gain of the four precious metals, gold is the big winner since 2000. But then you look, and it's up 424% since January 1st, 2000, rising from a price of $287 all the way up to $1,508. Now, silver, you say, well, that's pretty good too, up 235%. You could have bought silver in the year 2000 at $5.40, and right now you'd be sitting pretty at $18.12. Not a bad deal. Buy and hold precious metal since 2000, well, you're up 425% in gold. You're up 235% in silver, but it's not that simple. Very few people listening to this will say that they purchased all of their silver on January 1st, 2000 and never bought another ounce and never sold an ounce during that time period. But had you done that, had you plunked it down on the first of the year, 2000, you'd be up 425% in gold, 235% in silver. Had you bought palladium at $447 an ounce, you'd be up 302% because it's now $1,801. Just a note there that palladium is now the most expensive precious metal, and platinum is now behind palladium, and platinum was $440 an ounce on January 1st, 2000. It is now $935, and that's up 112%. So all precious metals are up, with platinum being the laggard over the 20-year period. So you can take a snapshot of that. I'll have all these charts up on smaulgld.com. Probably tomorrow morning you can check it out. I'll leave a link below the video. It'll be up on BitChute and YouTube. Now, we know that no one, virtually no one, only bought their gold or silver or platinum or palladium on January 1st and didn't sell any between then and now, but that's what we would have had. Now, here's where it gets tricky. Let's say you moved into 2008 and you were thinking in theory, beginning of 2008, I don't like the look of what's going on. I sense financial crisis coming. Maybe you're prescient, maybe you weren't, maybe you were just looking since 2000 to 2008. You saw things you didn't like, you saw some inflation on the horizon, but we hadn't yet had the financial crisis. Things were brewing. We didn't yet have QE. We didn't yet have the really artificially low interest rates yet. And you started to buy in 2008. Well, if you bought gold back then, you were paying $833. Why? Well, the price of gold was rising ever since 2000, and so was silver. Gold was $833 on January 1st, 2008. Silver was $14.80. Palladium was $378. Platinum was a staggering $1,528. Had you bought January 2008, well, your gold would still be up 81%. Your silver would be up a respectable 22%, but your palladium would be up 376%. You can see all the way up there on the top. And platinum would have been a big loser if you were buying, thinking that going into the crisis, platinum would have been a good deal. You pick some up at $1,528 an ounce. and it's now $935 an ounce. You'd be down nearly 40%. So silver was a relatively big winner from 2000 onward, but if you bought in 2008, well, you'd be up a bit. But remember, 22% gain over the course of 10 years, cumulative gain, that is pretty much a 2.2% gain a year. And even with a bank account, probably in the first couple of years, 2008 and 9, you probably outbeat the bank account, but because there's very little interest, if any, on a bank account. Maybe a CD, you might have done better if you put it in for 10 years. But not a very good return on investment for silver since 2008, and horrible return on investment on platinum, 38.8%. So the idea that you can buy precious metals, stick them in a drawer, and wait 10 years and think everything is fine, doesn't work that way for palladium, platinum, and silver. Gold, it does. See, since 2008, you're up 81%. That's not bad. That's an 8% gain a year. That's very good. Not really having to worry about it very much. It's not like you have a dividend stock. You got to worry about whether the company is going to perform or they're going to suspend the dividend. And 8%, there is no dividend stock that I'm aware of, a blue chip stock that pays 8% dividend. So gold, 10-year, 81%. Not the biggest winner. Palladium was, but remember, palladium is a spike and diver just like platinum, although it may have some more room to spike because palladium is so rare and has a commodity demand that it may continue to go higher. But remember, palladium and platinum really have no monetary history at all. Platinum has a little in the 18th century in Russia, but essentially palladium and platinum are rising just like rhodium or iridium or oil or what's the other one? Lithium. I don't know. Any of those, they go up, but that's based on their industrial demand. Now, silver also, most of its demand is industrial too. And that's why gold will have the more consistent, because it's not really subject to some kind of spur in demand because of catalytic converters for palladium, yoga pants for silver. There really is a inconsistent demand for commodities based on either economics or the particular industry that precious metal serves. All right, that's 2008, and you can see gold is the consistent one there, but palladium the huge winner. Let's go on now to 2009. If let's say now the crisis hits and you say, that's it, I've had it with this nonsense, I'm pouring into the PMs. Well, gold was $865 and it is now at $1508. You're up 75.4%. Again, about an 8% gain because now it's over 2009 to 2019, about a 7.5% gain. Silver's done pretty well since then. If you picked up silver just at the start of the financial crisis in January 2019, you'd be up 67%. Now, on that basis, silver has performed almost as well as gold, but you'd have to have purchased January 1st, 2009 to make sure that you're keeping pace with gold. Palladium, $183, is now $1,801, a huge winner. You'd be up 881%. Platinum was $899. It's still lower. It's now $935, so you gain 4%. But watch how things change when we move into, well, let's say you decided to buy in 2010. Well, when you buy in 2010, you're starting to buy silver at a much heftier price, and you're starting to buy gold at a heftier price, pretty much everything at a heftier price. But look at gold, 1100 to 1500. You'd be up 36%, so far you haven't lost anything. If you bought 2010, you missed the run-up, but you still got a little run-up going on. You're up from 1100 to 1500. Well, you buy silver, though, on January 1st, 2010. You're buying it at $17. It's only $18.12 now. You're only up 6.7%. Palladium, again, big winner. You bought it at $400. It's now $1,800, up 348%. And alas, platinum, you would have paid $1,466. It's now $935. You'd be down 36.2%. But here's where it gets real interesting and where you start to realize how much or how important it is to time your silver purchases. If you bought gold on January 1st, 2011, right now you're in mania. Remember, gold is racing towards an all-time high later that year of $1,911. Silver is racing to an all-time high of, or I guess a equal high of 1980 to $50 an ounce. If you would have bought gold in January 1st, 2011 in the mania, you would have paid $1,400. Well, now it's $1,508, so you'd still be all right. You'd be up 7% if you bought then and never sold, and going to sell right now. Silver was $30.63, as I mentioned, heading towards $50. Well, it's now $18. You're down a whopping 40.8%. See the difference here? Your timing makes a huge difference. Gold, you're fine. Silver, you're not. You lost nearly half your money if you threw it down in the mania. Palladium, $791. Well, it's $1,801 now. You're up 127%. Platinum was part of the mania, the precious metal mania. Well, you would have hit $1,731. It's now $935. You're down 46%. Worse than if you bought silver. And there's the difference. Silver and platinum versus gold. Why did silver and platinum not perform, even though they were close to they were heading as part of the mania? The reason is that silver and platinum have an industrial component. For whatever reason, was not in big demand, and down they went. In gold, it struggled along, but the monetary component kept it above water, even if you bought in 2011. Palladium, its industrial component, drove it higher, so it works both ways. So when people talk about silver and they're thinking about a collapse, the main way silver is going to really catch a bid is either behind the gold for monetary reasons, because only 15% of silver is for investment, or it needs to catch a palladium style bid and be in some type of shortage for yoga pants, or some type of shortage for solar panels, or some type of shortage for electronics, or some type of shortage for electric cars. So far it hasn't been, and that's why the price has not really gone into parabolic stage the way palladium has. Platinum could, if palladium gets way ahead of itself and finally a manufacturer throws the towel in. They say, we're going to bid up platinum because this is just ridiculous. If we can get palladium to work and platinum to work just as good as palladium, and palladium is 2 or 3 times the price, we're moving over to platinum. We don't know if that's the case, but that could happen. All right, now, let's say you bought in 2016. Well, guess what? Since 2016, if you bought precious metals, any of them, you'd be up. Gold was $1,000 in 2016 at the beginning of the year. This is the year that they were going to do Brexit. It's now $1,500. You're up 42%. Silver, you've done pretty well. You bought it at $13.82 after a horrific 7 or 8 years. You're starting to move up now. You're at $18.12. You're up 31%. Palladium continues its ascent. You bought it at $5.47 just a couple of years ago. 3 years ago, it's now at $1,801. That's still up 229%. And even platinum is starting to make signs of movement. Is finally above water. You bought it at $8.72. It's now $9.35 since January 2016. And all precious metals since just January 2018. Well, poor platinum. Platinum did not make it into positive territory. You'd be holding on to that now for almost 2 years. Down 1.1%. Not 1.1%, down 0.1%. Palladium is still up 65% in just 2 years, from $1,000 to $1,800. Silver was $17, now is $18, is up 6.2%. And gold, notice the trend here. Gold is up all the time. Gold $1,300 to $1,500, up 15%. But palladium, without a doubt, has been the standout performer. But again, gold rises for different reasons than palladium. They all have their own niche. When people try to do the gold-silver ratio, they're making it sound like the two are somehow tied at the hip as monetary metals. They're not. They have different percentages of monetary value. When I say value, I mean demand, different uses. They're different desirabilities. So that's why gold holds its value better than silver. But we've seen silver does have those spike potentials because of its size of the market. All right, well, you guys can ruminate on that and go back and look at the charts tomorrow on Smaulgld.com and figure out where you bought. But let's take a look now at a few other things. You remember Mike Baloney was always saying you can buy an ounce? That's also the other thing he said was, let's go back to, he said that in 2011, that this decade, that silver would be the greatest wealth transfer in history. I don't think so. That is not what's happened. But what he did also say in 2011 was that there would be times when you can buy a single-family home for 500 ounces of silver, probably no later than 2015, he said. And he also said most likely be around 200 ounces of silver. Well, right now, according to this chart from Nick Laird, that it would take 22,000 ounces of silver to buy an average U.S. single-family home. When he was saying this, it was about 5,000 ounces of silver, and now it's 22,000 ounces of silver. No, I'm sorry. When he was saying it, it was 5,000 ounces. I'm sorry. I was looking at 2001. He was saying it in 2011 when it cost 5,000 ounces of silver to buy a single-family home. It now costs 22,000 ounces of silver to buy a single-family home. Nowhere near the prediction, didn't even come close. Of course, he hasn't mentioned it since. All right. Let's take a look now at the Dow versus silver. That's another interesting chart. We look at Dow versus gold a lot, but we don't very often look at Dow versus silver. There it is. It now takes 1,500 ounces of silver to buy the Dow. Back in 2011, only took 220, 230 ounces. So silver has fallen greatly, but it does have room to run, and silver can always have a spike based on either gold rising, silver catching the similar monetary bid, that 15% demand part catches fire, and we're going to look at the Comex, and we're going to see open interest, and we're going to see how that might happen. And then, of course, there doesn't seem to be anything on the horizon that's going to boost silver demand for solar or for electronics, the two major industrial demands, because they do a lot of thrifting on solar. So even if they make 5 times more solar panels over the next 15 some odd years, that doesn't mean 5 times more silver will be used. They will figure out ways to use fewer and fewer ounces per solar panel. Same thing with electronics. Electronics are smaller and smaller, and they use less silver in them. So the demand for silver and solar panels is not exploding. In fact, for electronics, it's decreasing, even though the number of units are increasing. And for solar, it's increasing at a decent pace, but nothing that's... You'd have to find another use for silver, and it could be electronic cars, to really make the industrial demand exceed the physical supply, and that's not happening. So most likely, if silver is going to rise, it's going to rise because gold is headed high. And if you remember at the beginning of the year, I did say that if gold got over that 1275, 1375, 1400, 1500, that silver would follow, and that I thought that if gold did get to 1500, it would probably get to 1600, and that would drive silver into the $20 to $22 range. We got another 8 weeks left on that prediction, the only prediction that I made last year in December. All right, let's take a look now at the ETF stockpiles. Now, I also want to show you platinum and compared to silver. Both of them look like they're under accumulation. Here is the silver ETF. Now, unlike the gold ETF, which basically the amount of gold that presumably is held in these facilities rises and falls with the price of gold. Silver, you can see the black line is the price. Silver just keeps rising no matter what the price is. So it looks like people who are silver ETF buyers appear to be stackers. They're just piling on. They don't care what happens. The price goes down, they pour money into the silver ETFs. The biggest green thing at the bottom there is SLV. That's the largest silver ETF, and that is about 380 million ounces, and that's up. It's at its all-time high, even more than in 2011, and you can see all the silver in the ETFs are also at an all-time high at about 700 million ounces. Again, all these charts will be on Smaulgld.com sometime tomorrow, so make sure you subscribe over on Smaulgld.com. Also, if you are a Smaulgld Mug Stacker Game Changer and you're listening to the first time, make sure you subscribe to this BitChute, to this YouTube. And also we're going to have a little donation pledge later on in the program. But let's take a look at platinum. Platinum is following a similar trajectory, the ETFs, as the silver ETFs. They are at very little. I mean, it's like 3.7 million ounces compared to 700 million ounces of silver, but 3.7 million ounces of platinum are now in ETFs. And again, price is down, but the amount held in ETFs is higher. You can take a look at this chart at your leisure tomorrow on Smaulgld.com. And here is another chart just showing the idea of the price versus the amount of platinum in the ETFs. The black line shows the price, and the black line shows the value, which I guess is the price, but it's not showing the price per ounce. It's showing the amount of platinum held in dollar values in the ETFs. And then, of course, the blue line is the number of ounces, which is about 3.7 million ounces. All right. Now, we want to look at what's going on at the Comex. The Comex Vaults are bursting at the seams with silver, according to the warehouses that are part of the Comex system. And there's about 315 million ounces in the Comex Vaults there. Anyone who's telling you that's game over and game changer and there's no silver at Comex and someone big is going to stand for delivery is talking absolute nonsense. For many reasons. First of all, there's a lot of silver there, more than enough to cover any demand. And also, the reason that people trade silver on Comex is not to stand for delivery. You can do it, but the contracts do roll over, expire by their terms, or they just ask for delivery and they get it. All right, now let's just see who's holding all that silver. Biggest depository is JP Morgan, 160 million. But Brinks and Coins and Things, two other vaults, they got 50 million, 100 million between them ounces. And then you've got HSBC's got about 28 million ounces. And Delaware Depository, about 18 million ounces. And Scotia Mercado, about 18 million ounces. So all in all, you got 300 plus million ounces of silver. And this is silver, not just silver. This isn't, well, there's all that silver there. There's a lot of Silver Eagles, Canadian Maple Leafs, Canadian bars, generic bars. No. This is just, the only ounces we're counting here are 1,000 ounce good delivery bars, 9995 silver that is Comex approved for trading. These vaults will have, I know Brinks and Delaware Depository Company will hold your silver. I'm not sure if JP Morgan does it for clients as well. I mean, they'll hold the Comex silver. I'm not sure if they'll hold other silver, but Delaware Depository, Brinks will definitely, you can send them monster boxes, you can send them bars, and they will hold it. That silver is not included in these calculations. And I'm probably tens of millions of ounces held in that form as well. Now, let's take a look at the open interest, and then we'll take a look at the silver and Indian rupee. Now, a lot of people get this kind of confused here, but open interest is very important. And open interest is very high. In fact, open interest is higher now than it pretty much ever was. It's been peaking since 2018. It's a little below the all-time highs, but the volume is pretty low. What does that mean? Okay, well, we got to know the difference between open interest and volume. The volume is the actual number of contracts that are traded between buyers and sellers, and that volume is relatively low. However, the open interest, that's the number of options or futures that are held by the traders in their inactive positions. They haven't been closed out, expired, or exercised, which means there's a lot of interest out there. They just haven't gone through the mechanics of doing whatever their position requires them or allows them to do. So open interest when the price is rising, that's a good thing, as Bernie would say, because it indicates that there's a lot of open buying interest. If the price is dropping, well, maybe that's not a good thing. But anyway, the volume is low, however, so this could indicate that we may see some fireworks to the upside, or maybe it just means these contracts just roll over at current. Who knows? But it's a good thing to see a lot of active interest in the silver trading market and also in the accumulation in the ETFs and the accumulation or the additional ounces flowing into the Comex warehouses. All right. I think that's all we have for Saturday night silver tonight. Let's just see if... Oh, yeah, no, we got to talk about the Indian rupee. Now, the gold imports have suffered the last couple of months in India, and India gets all of its gold pretty much either through whatever's in the country, of which there's 18 to 22,000 tons of gold, most of it in the hands of private citizens. The central bank is 680 tons. The temples, they say, have about 4,000 tons. The people have about 20,000 tons. But most of that gold, if it's not traded internally, if they need new gold, it has to come from imports because they don't have domestic mining production like Russia or China or Australia or Kazakhstan. So they got to import a lot, and they were doing pretty well. A lot of imports up to about June. When the price started to take off, the imports came to a grinding halt, and then the silver imports took off. However, that's because the gold was very expensive in Indian rupees. Now remember, gold is up 10-15% this year, but in Indian rupees is up 30%. Same thing is starting to happen now in silver. Look at the price of silver in Indian rupees. It's starting to move up. It's 1,400. It's not far. I mean, it's not as far away from its all-time high in Indian rupees as it is in dollars. Remember, dollars went to $50 an ounce, and now silver's only $18 an ounce. But right now, the silver in Indian rupees is like 1,300 rupee per ounce, and the all-time high is only about 2,180. So that could have an impact on physical silver and gold demand now in India. All right, and I think, yes, that indeed is it. And so if you enjoyed this presentation, we're going to take some comments. And if you did enjoy this presentation, please consider becoming a Smaulgld patron or making a one-time or recurring donation on PayPal, or becoming a Subscribe Star Mug Club member, or sending items of value, or checks, or cash to Smaulgld LLC, P.O. Box 714, Dover, New Hampshire 03820, or sending Bitcoin or Litecoin to the addresses on the screen or below this BitChute or YouTube or on the Smaulgld website. You can hold up your phone to the QR codes and donate that way, or you can buy a Smaulgld mug and become a Smaulgld mug stacker at the links below. And you can also help the site out if you're interested in buying gold, silver, storable food, coffee from the Smaulgld affiliate links. If you click on those links, you'll be taken to find merchants like SD Bullion, Money Metals Exchange, I think wine.com we even have, and Golden Eagle Coin. And if you do purchase from those links, Smaulgld gets a small commission. So please, if you are going to purchase any of those goods, please consider supporting the Smaulgld site that way. I do want to put a shout out to those who have indeed sent Bitcoin, Litecoin, bought Smaulgld mugs, or Subscribe Star mug members, or donate via PayPal, or send items of value, or Smaulgld patrons. I did get a very nice gift the other night. I received some amber, and while I'm going to show you that. I think I can still find the amber. The amber is beautiful. From a long-time Smaulgld listener. And if I can find it, I'll show it to you. If not, we'll have to do it tomorrow. Tomorrow night is Solid Gold Sunday with Smaulgld. We've covered just gold. And then next week, we've got some crypto stories to cover. We've got some Fed and Donald Trump stories to talk about. So let us see what we have here. And I will start to take your comments. Just moving over to the comments here. I'll be right with you. Oh, can't find the amber. All right. Let's see what we got in the comments section. All right. We got Jack here, or Saturday Night Silver. Trey Snow. He's here for the awesome music in the beginning. I want to shout out to Mark Battaglia, who creates all. Those are all original Smaulgld tunes. The introductory song. That particular song, I think, was called When Lambo. Doug Bailey is here from Kalamazoo, Michigan. All right. Chuck and Plata is here. All right. You guys are chatting amongst yourselves. Let's see. Pablo Pino, Late Night with Smaulgld. Yes, indeed. Jack, someone brought up a good point. You save $10,000 and price of gold rises, your wages rise, but your savings stays the same thanks to inflation. Yes, of course. Chuck and Platt are still waiting for McDonald's to start accepting silver per payment. That's never going to happen. All right. Okay, Doug Bailey says, I'm all in on silver. If the dollar's going to zero, why would you hold anything else? Well, the question is, why are you so convinced the dollar's going to go to zero? Now, you can say, well, the United States has $23 trillion in deficit, $150 trillion in unfunded liabilities. But you got to keep one thing in mind when everybody tells you that. That's all true. And there's a lot of debt and it'll never be paid back. But the one thing about the dollar versus all of the fiat currencies, there's a global demand for the dollars. Why? Because all the other countries, when they lend money, they lend it in dollars. So all the debt is denominated in dollars, which creates a need for the dollar. So the dollar is the last currency that's going to go to zero. I would say if you were in Turkey, Argentina, Venezuela, Russia, any other country, it makes so much sense. You know your currency is not going to be supported against gold. Now, silver, this is a big mistake people make. They somehow think that silver somehow is a substitute for gold and it's cheaper, so you might as well buy silver because when everything goes down, that silver is going to be somehow reignited. That historically has not been the case, is not where things are headed. In my opinion, it is gold is... If you look over the last 10, 15 years, silver has underperformed the Indian rupee on a certain number of years over the past 10 years. Gold always outperforms just about every major currency, every minor currency. Silver does not. Silver has underperformed. So the idea, well, if the thesis is the dollar's in trouble, so I'm buying silver, first of all, the dollar isn't in trouble. The dollar index is moving higher. The fiat currency system is in trouble, which means all the minor currencies are going to get clobbered and are getting clobbered against the dollar. The only dollar is actually the supreme currency other than gold. Gold outdoes it. Some years, even gold, oddly enough, the dollar in some years, as we know, outperforms gold. Gold has gone down a few years against the dollar, but overall, the dollar cannot compete with gold. But the dollar does just fine against silver and has done just fine against silver the last 10, 15, 20 years. So the idea, it's a little messy when people say, when they think that somehow it's a slam dunk that I'm going to buy silver because the dollar's in trouble and silver is somehow the monetary metal that everyone's going to run to. You got two assumptions there that are half true and half not true, and therefore two half-truths make a wrong. All right. Let's see, whatever you guys are talking. If you take the well, here's the thing, Doug. Here's what he says. If you take out the ETFs and all their paper products, silver will be unstoppable. Yeah, but here's the thing. This is very, very important to realize. The trend of investment dollars has been towards the paper, the digital, the ETF, the contracts, and away from physical buying. We're coming into this, I don't know how old you are, but if the older you are, the more, I guess, baffling it is to see people not wanting to take the possession of the physical commodity. Gold ETFs, silver ETFs, the demand for those is skyrocketing. The demand for physical gold and silver in the last 10 years has gone down. If you look at the bullion dealers, 3 have gone out of business. The U.S. Mint numbers have been declining since 2015 significantly, down 50, 60, 70%. This year has been horrible for U.S. Eagle sales, gold eagles, silver eagles. Now, you cannot look at things the way you look at them. When I say that is, logically, you look at it and you'd say, well, I'd rather have the gold coin. I'd rather have the monster box. Therefore, everyone must want that. No. Those sales are down and they want the ETFs. They want that kind of stuff. So, you're not going to take out the ETFs and the other paper products because those are what institutions want. That's what they trade. That's what large individual investors want. That's what they trade. So, again, the thesis is wrong. Yes, it's true. If you got rid of ETFs and paper and you went and you got rid of the Comex, yeah, of course. And people had to buy gold and silver based on the then going price, based on supply and demand, sure. But we're not heading in that direction. All right. We have sales tax on PMs in Ohio now, says Phil McCain. Okay. All right. Amber from the Dominican Republic, Chuck and Platt. Yeah, there is amber in the Dominican Republic. The particular amber I got is from Fiona, and it is from I'm sorry, you can't say the Ukraine. You have to say it's from Ukraine, and that's where it's from. Don't forget Bernie. Thank you, Matthew, for reminding. How dare you? I shouldn't be here. I should be with Bernie. All right, Smaulgld album, haha, Lambo. I'd buy a Smaulgld album, says Trace. So, yeah, I like to put together. I was thinking of putting together. I asked him if I can put together like an MP3 package of all of his tunes. They're really cool. All right. Yes, Jack says people are just looking for price exposure to ETFs instead of paying premiums. It's true. When you buy gold or silver, you have to take delivery of it, you have to store it, you have to insure it, you have to make sure it doesn't get stolen, then you have to sell it. You buy it at a premium, then you sell it at a premium, and it's a messy process. And here's where, because you can't spend it in that form, all you can do is convert it back into fiat. So if the theory is, now think this one through. You go out and you buy, I don't know, $1,000, $10,000, whatever the number is, $10,000 of gold or silver, and then you take delivery of it. What you're hoping is it rises in value so you can sell it for fiat currency. I would think, because most people are always quoting the price of gold and silver in the fiat price, and that's why they're upset, because the price has gone down versus the dollar, or the price has gone up. They want it goes up, they're going to sell it. Well, if that's what you're going to do, what's the point of holding on to it during all that time? And if you're storing it somewhere, what's the point of that? The only point of it is the certainty that it's yours. But if you had an ETF, yeah, you couldn't get the ETF. They're not going to send you the gold or silver. But if the price goes up, you can flip it out and you can get your fiat money. The only reason you should hold gold or silver is if you believe you can actually spend it one day. Or you think the whole world is going to collapse and somehow having a monster box of silver is going to help you out, well, then that's the reason to buy it. But anything over that, there's really no point in holding that much of it, because all you're going to do is, if things don't go south, you're just going to turn it in and get fiat cash for it and spend it on your mortgage or spend it on a car or put it into your kid's college fund, or if you're not going to college, put it into something, put it into a business. Because the world runs on fiat money. You don't spend you don't print the money, you don't spend the money, you don't spend the gold, you don't spend the silver. What are you going to do? So that's why you can see the popularity in today's digital world. You're going towards assets that can be stored and spent. And that's why now they're even talking about putting gold on the blockchain. You got David Morgan and Bill Murray, whatever his name is, from Gata. They've got this load where you put your silver on the blockchain. I actually think that's silly too, because you might as well just have silver in an ETF. I mean, I don't understand what the load is. But I'm not trying to denigrate the product. I don't know much about it. The point is that people are moving towards, if you're trying to make silver spendable, the least spendable form it's in is in the actual form, physical form. Now, I will say the best silver, if you want to spend it ever, and you may never get to spend it, but in a crisis situation, I do believe that the best silver to spend will be silver dimes, quarters, and half dollars. 90% what they call constitutional silver, 90% silver, junk silver. That's the silver that I believe, if we ever get to it where you have to spend silver, that's the silver to have. And right now, that silver has a low premium because a lot of people who are silver stackers, they scoff at it because it's 90% silver and it's not a quarter, isn't a quarter ounce, a dime isn't 1/10 of an ounce, and they want the shiniest and the newest and the 999 purest silver. Well, good luck trying to sell that or use that in any type of crisis. Well, all you're going to do is sell it. It's almost, you can say, well, why don't you have the ETF? Well, you'd say, well, if there's a crisis, I want to have that. We'll try to convince somebody that a a silver round with some face on it saying new paradigm is worth more, or is even worth an ounce, or you can even say it's an ounce. You have to go through a whole process of convincing somebody that it's an ounce of silver. Then you're gonna have to prove it's an ounce of silver, and then you're gonna try to gain some premium on the semi-numismatic. You can forget that. But if you had a roll of silver dimes, you can easily show somebody that that is got 0.01670, whatever it is, ounces of silver, or the face value of silver. A dollar worth of silver is worth $30, $50, whatever it might be at the time. And they can trust it because it's a U.S. coin. They've seen dimes before. They've seen quarters before. They've seen half dollars before. All you got to show them is before 1965. And now you know that you've got silver on your hands. All right. What else do we got before we get to Bernie? All right. Mario Draghi. Yes. Mug Life. Yes. Matthew Rose. Mark Dice showed how clueless Americans are about gold. Snickers bar of a gold coin. I like to use that one, Matthew, because people say, oh, if there's a financial crisis, people are going to clamor for gold. No, they're not. They're more likely to clamor for chocolate bars or chocolate-backed dollars than they are for gold. They don't even know what it is. If they were ever going to clamor for it, you would have thought it had been 2008, 2009, and they didn't do it. All right. Let's see what else we got. Yeah, Jack, I always dream of seeing Mark Dice on the beach ask me the value of a 100-ounce bar. I would definitely take that bar. All right, let's see. All right, well, it looks like we're about done for tonight. I want to thank everyone for joining me tonight. And tomorrow will be Solid Gold Sunday with Smaulgld. Got a very good stack show for you tomorrow night as well. And then we'll see you next week as well. Thank you very much indeed. And oh, yes, Bernie. Now, I've told Lewis that this might be one of the last times that, look, I had a heart attack, and to work for free and not get a living wage, and to have to come on the list late at night and give a countdown to a bunch of 1%ers is not my idea of a good time. Now, I'm going to do it. Bernie, look, you're not really doing me any favors. It's just part of the tradition of the show. If you want, look, I don't need any double talk from you. I know how to count to 10. I know how to count backwards, forwards, and all twice. I know my economics. No, Bernie, you don't know your economics. You barely know how to count. Look, Bernie, just do the countdown, and we'll talk about it later, right? All right. Okay. 10, 9, 8, 7, 6, 5, 4, 3, 2, 1%. 0. Have a good night, Smaulgld. Have a good night, Bernie. Have a good night, everyone.